Let's bring in Mohamed El-Erian, Chief Economic Advisor at Allianz and President of Queen's College at Cambridge University. Mohamed, I know you heard we were talking about there. I'd love, though, your take, bigger picture. I mean, as the Federal Reserve officials get together today, they have to be feeling pretty good in general. I mean, the economy's holding up better than they had anticipated. Inflation has come down even a bit faster than they projected. And even if we're talking about when they might start rate cuts, it's in the guise of normalization and it's not an emergency. So how are you thinking about their job this week?
So you're absolutely right. They're going to welcome the reduction in inflation. They're going to take a lot of comfort from the fact that it didn't come at the cost of growth. The U.S. economy has been exceptional, and the Eurozone data today reminded us of this U.S. exceptionalism. They're also going to say that their job is not done, and they're going to maintain optionality. And most importantly, I think they are not going to validate the notion that rates are coming down in March. They're going to keep their options wide open. That's where they're going to end up. That's the committee. What's interesting is what the chair is going to do during the press conference, because we've seen in the past the chair does sometimes diverge from the committee. So it'd be really important to listen very carefully to what the chair says.
For sure, Mohamed. Although I do think that the market, I mean, to the degree to which we want to, make something out of this perceived gap between how the market is positioned about rate cuts and what the Fed has been saying. I mean, if you just stack up all the things we know about how the Fed has said it will respond, you have a 5 3/8 Fed funds rate right now. Inflation is way below that. They've talked about how that represents a restrictive policy, even if we're not really seeing it in the economy. We've had this 6-month average a lot of people are seizing on of core inflation being very close to target. And so all those things put together, and, Powell has said, yeah, of course we're going to be cutting before we get to target. So I guess the question is just exactly how much work do you think he'll even try to do to talk the market in a different direction?
It's hard to tell. Predicting him even within the same press conference is tricky. So it's hard to tell. But you're absolutely right. They have the scope to cut rates. I don't think it's going to be as aggressive as the market thinks. Exactly where the consensus is in the survey that Steve shared with us. Why is that important? Yes, we all end up at the same destination in 2025. But remember, we've become a single issue market. Our focus on the Fed and our focus on the Fed loosening liquidity conditions has allowed us to sideline all sorts of other issues, including geopolitical risk. So where this comes in is can we continue to rely on our focus solely on the Fed to sideline all these other issues that are mounting on the sideline?
Are we really a single issue, though, in terms of the pacing of the Fed rate cuts? Because, we were at, close to 90% for a March rate cut right after the previous Powell press conference. We're down to a 50-50. Risk markets have done well since then. The economy hasn't missed a beat. In fact, if anything, we're getting the impression that the economy has been a lot more resistant to higher rates. I mean, look, investment grade yields, they've had their effect. They're above 5%. They were nothing a while ago. You would think this would start to bite, but it's not really doing it just yet.
Right. And there's this big debate, Mike, between flow versus stock. If you focus on the flow, then you would be incredibly optimistic about both the economy and the markets. Inflation is coming down, interest rates are coming down, affordability for consumers is going up, corporates can refinance much more easily, ample liquidity. The flow side is really encouraging. We just have to manage the stock. And the stock is first the lagged effect of the rate hikes. Mm-hmm. Second, the fact that you have certain asset classes that are slower moving in acknowledging that change circumstances. Think of commercial real estate as one, but there's others. And then third, we have a maturity wall coming up on the corporate side. So what we're going to see this year is this tug of war between favorable flows and challenging stock. And that's how it's going to work out. Now, if you can bet on the Fed accommodating the situation, which is what the market is saying. The market is saying they're going to cut early aggressively, so we're going to be able to deal with the stock. If you can bet on that, then your outlook becomes much more positive than otherwise.